Rio Tinto, ticker RIO, is currently trading at $62.33, and over the past month, the stock price has fallen by 4.24%. Now, over the past year, the stock is down by 12.01%. Now, if we have a look at the maximum graph, we can see that since 2016, the stock price has been rising steadily, reaching its maximum of $88.23, which is quite higher than the current trading price. Now, one of the main reasons why I believe the shares of Rio Tinto will go up in price over the next few years is that over the past few years, many countries, including China, have been limiting their export of raw materials, which will undoubtedly lead to higher demand for Rio Tinto services. And this is also why TIP ranks as a 53.56% upside on Rio Tinto, expecting the stock price to climb as high as $95.64 at the end of 2023, and with 3 buy ratings, 0 hold ratings, and 0 sell ratings. Now, to find whether Rio Tinto is really a buy at its current trading price, we'll jump over to my fully automated stock valuation spreadsheets, where we'll have a look at the 9-pill analysis and find the intrinsic value using the Grams formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model. And all these models will lead to our ultimate valuation at the end of the video. Now, if we jump back to the stock screener, we can see that the starting dividend yield for Rio Tinto is sitting at 14%, which is a very good starting dividend yield. The dividend payout for Rio Tinto is sitting at $9.09, which means it will be paid about $4.5 every single 6 months, as Rio pays out its dividends twice a year. Now, the payout ratio is sitting at 95%, which in my opinion isn't that big of a red flag, as Rio Tinto doesn't need to direct a large proportion of its income or free cash flow towards innovation, as they are in the mining business. On the other hand, the institutional ownership is sitting at only 12%, which in my opinion is quite low, and that might be a slight red flag in this case. The beta of the company is sitting at 0.69, which means that you won't see much volatility with Rio Tinto as you would see with the overall market. And finally, up here we can see that the overall income for Rio Tinto has decreased from the year 2022 to the year 2023, as well as the cash flow and the metrics on the balance sheet. But now we can move to analyzing Rio Tinto using the 9-pair analysis. We will plug in the ticker Rio up here, and as you can see, all the metrics show up automatically, giving us a 9 out of 9 perfect rating. And right away we can see that over the past 5 years, Rio Tinto has been increasing their revenue by about 8% annually, as well as increasing their free cash flow and net income by almost 33% annually. The 5-year profit margin over the past 5 years is sitting at almost 40%, and they are decreasing shares outstanding over the past 5 or so years. And the price to free cash flow and the PE ratio over the past 5 years are both sitting at a very low value, which is great. Finally, we can see that the long-term liabilities over the 5-year free cash flow is indeed very low, sitting at only 0.61, meaning that Rio can pay most of its debt in about 1.5 years. Now we can jump to finding Rio Tinto's intrinsic value, first using the Grams formula revised. I've already plugged in the ticker Rio here, and right away we can see that the earnings per share is sitting at about 7.87. Now, as the analysts currently project a negative earnings per share over the next few years, I plugged in the earnings growth estimate to be 1, which won't affect our intrinsic value, which came out to be $63.95, very close to the current trading price. Now we can move to the discounted cash flow model, where we will again plug in the ticker Rio. And right away the free cash flow over the past 10 years shows up automatically, calculating the average growth rate to be about 37%. Now, over the next 10 years, I project a future free cash flow growth rate at 6% annually, and this will allow me to calculate the future free cash flow up till the year 2031. Now, to move forward with this valuation, we will need to calculate the present value of that future free cash flow, which we will calculate using the discount rate, which is currently sitting at about 10.5%. Using that discount rate, we calculate the present value of the future free cash flow, sum that up, add any cash and cash equivalents, subtract total debt, and get an equity value of $160,000, which we divide by the shares outstanding and get an intrinsic value of $127.93. Quite different to the current trading price, showing that Rio Tinto does indeed have very good free cash flow. Now we can jump to the third valuation model, which is the multiples valuation model, and here I will be comparing Rio Tinto to Anglo American PLC, BHP, and Teck. I took these companies' current stock prices and divided by their current earnings per share to get their PE ratios. I then averaged out those PE ratios and get an average PE ratio of 7.29. I multiplied that PE ratio with the earnings per share of Rio Tinto and got an intrinsic value of $55.57, showing that Rio Tinto might be slightly overvalued compared to companies which operate in the similar sector. But now we can move to our final valuation, the dividend discount model valuation. Here the program plugged in the dividend payout over the past 5 years and calculated the average growth rate to be at 49.23%. Now this growth rate isn't necessarily correct, as over the past 2 years or so, Rio Tinto has actually paid out a few spontaneous dividends. And if we analyze the dividend payout charts for Rio Tinto over the past 10 or so years, we can see that the actual growth rate is sitting at about 3% annually. Therefore, I project a growth rate of only 1.6% over the next few years, which gives us an intrinsic value of $69.21, about $5 higher than the current trading price. Now that we have completed all the valuation models, we can move to our ultimate valuation model, where we averaged out the grams valuation model, multiples valuation model, discounted cash flow valuation model, and the dividend discount model to get an intrinsic value of $79.77, which is currently about 22.82% higher than the current trading price of Rio Tinto. Now, if we were to plug in a margin of safety of 15%, we would get an acceptable buy price at $67.29, still slightly higher than the current trading price. Now, if I was to plug in a margin of safety of 20%, that would give us an acceptable buy price at $63.33, slightly lower than the current trading price. Now, personally, I do believe that Rio Tinto is a great buy at its current trading price, considering that over the past few years, many countries, including China, have been limiting their export of raw materials. With this said, if you find these spreadsheets helpful and would like to download them for yourself, you can access them on my Patreon at the link in the description. Also, make sure to like the video and consider subscribing if you want to see more content like this.